Hello, everyone, and welcome back to the PetroNerds podcast. My name is Trisha Curtis. I am the CEO of PetroNerds and the host of the PetroNerds podcast. I am delighted to be with you here this evening. Today is Wednesday, May 1st, 2024, and this is a bit of an emergency drop podcast episode. I'm doing this in the evening, and that is because the Federal Reserve Chairman Jerome Powell spoke today. The Federal Reserve met, and they kept rates unchanged. So we're still at 5.25%. But there was a lot going on today, and it really does warrant a sort of a discussion because there's a tale of multiple worlds going on with what Jerome Powell said, how the market reacted, what the market was doing in the run up to what he said, and then the reason the market was reacting the way it was is because of the three hot inflation readings we've had, and then we have pretty serious move in oil prices, as well as a market move in companies like Starbucks and Yum Brands, which is KFC and Taco Bell, and McDonald's and Estee Lauder, and all these companies not doing great because of inflation and in the U.S. and also which means pressure on the consumer, something that people have said the consumer is just resilient, and they're going to be great, and also really downbeat sales in China as well. So two of the two biggest economies in the world not doing so great. But importantly, I want to put this in context of what happened with the Federal Reserve. So we're going to talk. I don't have a full transcript, but I did listen to this today. And importantly, I want to know is I was listening to this as I was walking my dog. And when I came back into the house, I was pretty shocked by the stock market's reaction because I actually thought the stock market was going to react pretty negatively. Now, I am not giving investment advice on this podcast. However, I would say, I think in the coming days, especially tomorrow, I would expect that the stock market and folks that are really analyzing this are going to think that this was more negative or at least a little bit more hawkish than they realize. And there's a few reasons for that, which I'll get into in just a minute. But I'm going to timestamp this with WTI is at 79.21. We have lost a couple bucks just from yesterday. Brent is at 83.68. We've lost nearly $5 from yesterday on Brent. So we're seeing much bigger moves on the Brent side. Henry Hub is still under $2 at $1.95. Dutch TTF is 902. JKM or Japanese LNG is 1024. We're looking at the 30-year mortgage rate despite all this Fed volatility and moves, which is one of the reasons we're having such volatility in oil prices, which I've talked about in previous podcasts and really try to beat the dead horse with my clients and with podcast listeners. The 10-year yield moves 30-year mortgages, but it also moves oil prices. So when you have all this Fed rate volatility and all this volatility in the stock market, you have a pullback and you have a pull in and a move in oil prices, typically to the downside. So, and it can be to the upside, but it often with this volatility is to the downside. So our 10-year yield is 4.628. So for all the talk and the sort of what I thought was a dovish interpretation of Jerome Powell's speech and the questions afterward, that for all that talk, the yields actually have not materially moved down. And so what happened today was we had three hot inflation readings in January, February, March. And every time Jerome Powell has spoke he corrected this, and I've talked about this in a previous podcast. He basically said in the last read, in the March reading, in recent speeches in April, he said, hey, we are not seeing enough progress. And so the stock market, which was baking in 7 rate cuts, which were never going to happen, that was absolutely ludicrous. So the market was way over its skis, baking in all these rate cuts, and they needed it to give the reason for earnings to go higher and having 20x multiples and 20 times forward earnings, which are just absolutely ridiculous. But they did the same. Now, this is all in the backdrop of sticky inflation and a consumer that everyone thought could just be resilient, and now they're not being as resilient. So we have all this run up. So you have to take all the steam out of the market. And what happened was that you have these hotter than expected readings. You have what Jerome Powell said. And then we had this last reading. And so everyone thought that because we've had this, that Jerome Powell is going to have to come out and be far more in this thing that he's actually going to hike rates. Now, no one actually thought he was going to hike rates. That you hear today, people said, oh, he took rate hikes off the table and that's why the market rallied. If you know Jerome Powell or you've listened to the Fed or you listen to any of this, you know that they weren't going to hike rates. Now, one person, there was lots of different commentaries of different folks in the Federal Reserve commenting and to the market, and they said potentially a rate hike is needed if the data is warranted. Now, the data is not warranting. You know that's not what the Federal Reserve was going to do. So I think the stock market was overreading and stretching for the reason to go higher today. And then it rallied and then it sold off. So I think tomorrow you're going to see looking at the data more appropriately, looking at what was actually said. But I'm going to read this to you. So I listened to this. You can actually read the words and get the transcript via YouTube. And I saw that part of the transcript is available on CNBC Pro, which I don't have, but part of it was available in the little, teaser version. And so Jerome Powell opens this up, and I think the opening is really important because he says he's opening this up, and I thought, listening to him, that what he said was more hawkish. His tone is dovish. That is what Jerome Powell does. I've talked about this before, but he tends to say everything in a dovish tone, and I think that's how the market reacts as well. Personally, I'd prefer him to be a little more hawkish and just a little more clear to the market. But because we've had all these rate moves on their own, a lot of that's sort of done for him when he says, "Hey, we're not gonna be cutting rates anytime soon because we have more work to do on inflation." In this meeting, he basically said, "We're not cutting rates this year." Essentially, rate cuts were taken off the table, which is why I think the stock market should have actually moved lower initially. But he says, so I'm quoting, he opens up saying, "Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. The economy has made considerable progress toward our dual mandate objectives. Inflation has eased substantially over the past year. Inflation has moved substantially over the past year, while the labor market has remained strong. And that's very good news. But inflation is still too high. Further progress in bringing it down is not assured, and the path forward is uncertain. We are fully committed to returning inflation to our 2% goal." So I think this is really important to realize that. And I thought, as he's saying this, I was like, good, that's what I want to hear, is that you are committed to returning it to 2% and that we haven't achieved our goal. Now, and actually the questions he got initially were all very inflation directed. And often he's asked a lot about interest rates and how that's hurting the lower end consumer. And he's asked about employment. And there was a lot less of this. This was stuff really focused on inflation and rate hikes versus rate cuts. And essentially he said, I don't see stagflation. He doesn't see the stag or the inflation. He also said that he didn't see, if a rate cut was not likely, but he did say they would be very data dependent. And the fact that he's saying they'd be data dependent and they had 3 consecutive quarters, which showed them that we have this stickier inflation, and he doesn't say sticky. I do. And I think that's why people say stagflation, because we're seeing the sticky inflation. It means that he's looking for multiple. We're not 1 quarter of inflation coming down is going to be enough. They're going to have to see multiple quarters. And so you're coming off of a high base of 9% inflation was our peak. Now, that's really, really important to understand, because what we're seeing in the stock market and what we're seeing in the consumer spending by these stocks, and what Starbucks is telling us and what all these companies are telling us, is that the consumer is had it with inflation. And when you're coming off a high base and you haven't seen prices materially decline and you are not seeing your economic well-being increase, you are pulling back. And so the problem is that, yes, inflation is the percentage of price increases every day are declining, as in they're not increasing as much, but the actual price of the basket of goods is actually still increasing. So your prices at Starbucks are still increasing. Your price at the grocery store is still increasing. And guess what? Gasoline prices are increasing and utility bills are increasing. And so the consumer is just getting smacked. And what's, I think, very fascinating is that you have this dovish tilt by certain folks that are doves saying, what we need to actually do is lower interest rates. And if we lower interest rates, that's really hurting the consumer, because people can't buy houses and they can't get in the market. If you lower interest rates, that was half the problem. Is we had very, very low interest rates when we didn't need low interest rates. We had 0% interest rates and everyone went crazy and people bought 2 houses and they bought boats, and they bought campers. That caused inflation. So now you've got higher interest rates. They have basically one tool, and it's lower and raise interest rates. They should have raised them a long time ago. They shouldn't have had them at 0% in the first place. And you shouldn't have had all this easy money in the system. This was way too much money and easy money in the system way long after it was needed on COVID fears. And I think on the look back on COVID, that was a horrible miscalculation in the first place for how much money was pumped into the system. What Jerome Powell doesn't talk about, and is a big problem, which I mentioned, is that he doesn't talk about the fiscal spending. He doesn't talk about the fact that, they have rates at 5 0.25%, but they have very high fiscal spending. So all the stuff they're trying to do on the rate side is being combated by very high fiscal spending, which is essentially a stimulus. And there's a lot of conversation going on right now that, oh yes, we have high fiscal spending, but so did the previous administration, and so did the previous administration. I encourage you to look at the charts and look at the graph. It is different right now in many ways. And the reason it is different is because it is this, we could have pulled back and you could have maintained just the increase we have, but we have continued to see material increases in federal spending. And so when you're materially increasing federal spending on the back of inflation, which you've already had, it's been rip and roaring, and you continue that, and you also have high interest rates. Now you have a much higher federal deficit. You have a $1.7 trillion federal deficit, and you have these high interest rates, which means your interest payments are $1 trillion a year. And this is just a very unsustainable situation. And so just like it's unsustainable for the federal government, it's unsustainable for the consumer. So when people are calling for lower interest rates for the consumer, that's not what they need. If you have a consumer that is tapped right now, but you have 3.8% unemployment, that tells you that yes, they have a job, but prices are too high. And so if you lower interest, and people say, well, their credit card debt is, the interest payments too high. So are you saying that we should be lowering the interest payments and encouraging people who can't afford going to McDonald's to actually take on debt to go to McDonald's? That's ridiculous. What you're seeing is that the economy needs to be reset. You need lower inflation. You have to have we've got to curb inflation, because what we see in the data, what we see in the earnings calls, and this is so important. This is why I don't think the stock market's going to be able to maintain any kind of a run up or material run up. One, they're going to have to parse out what the Federal Reserve said, and I want to come back to what he said, because the market isn't talking about something a word he took out, and that's that sufficiently restrictive. He took out the word sufficiently. And so when people said is policy restrictive, he said it is restrictive. He didn't say it was sufficiently restrictive, meaning it's sufficiently restrictive to take prices down to the 2% inflation goal. He didn't say that. He said it is restrictive, and they have to figure out, basically, is it sufficiently restrictive, which means you could actually have another hike. Also, which means you could have to keep rates where they're at for much longer. So the fact that he took out the word sufficiently, I think, is really material. It gave them some wiggle room. It also is telling you the Fed doesn't know what they're doing, that they're watching, they're trying to figure this out as they go. He says in the very beginning, it's uncertain. And he said this multiple times. But the problem is that the market needs a little more certainty, and they are going to, if they aren't getting inflation down, the impact is already happening to the market. And so we see this in the actual earnings data. And this is coming out in the economy. So Yum Brands, which is KFC, Pizza Hut, and Taco Bell, those they said that they have a decline, and you're seeing that on headlines across Wall Street Journal, CNBC, but you're also seeing Starbucks. So I talked about this in a LinkedIn post yesterday. Starbucks got hammered, and I listened to the earnings call. They are really down on a whole across the board. Starbucks is down, and so they had a material decline in sales in the U.S. So foot traffic was down, but they attribute this to inflation. They attribute this to the consumer being tapped out, and that the consumer doesn't have as much discretionary income. Now they talk about, the stimulus has worn off. Whenever you hear companies, and we heard this like 2 years ago with Target and Walmart, when they had stocked up on bikes and everything, and they said stimulus. Well, that was because everybody went crazy. One, it should have been a sign that we didn't need the actual stimulus. And two, if your earnings, if your sales are on the back of stimulus, something's off, right? You want to see a healthy consumer should not be based upon a stimulus package in the US. We need a healthy economy that is not reliant upon stimulus packages or low or excessively low interest rates. And so what we're seeing is that we don't have that, right? We're seeing inflation despite 5.25% interest rates. And so you're seeing Starbucks, their decline in the US. You're also seeing a material decline in China. And it's really important to point this out. I want to loop this back to China after we finish on the US, because you're hearing this across the board from Estee Lauder to other companies, that you're seeing really a material declines. Apple, Estee Lauder, you name it, McDonald's, all declining in China. Now, McDonald's declining in the US is also a big deal. And that's because these are, you would expect McDonald's to actually perform decently well. And the reason these companies are not performing decently well is because they have had inflation. And so companies like Walmart are doing great because they're where 60% of the people shopping, over 60% of the people shopping at Walmart are making over $100,000 a year. That means that those people are not finding deals anywhere else. And so they have moved down from maybe Whole Foods or other places, and now they're shopping at Walmart because they're looking for a deal. And Walmart, because they have this, their segment is so high in grocery that they have more purchasing power and ability to keep those prices lower. You can get a little more competitive with Walmart, and I think you are seeing a bit of a drop in grocery prices. But overall, if you've looked at the data and you've looked at, what Bloomberg and others have said, your basket of groceries overall is 33% higher than it was pre-COVID. So that's why I say it really matters, and that this sticky inflation, it's not that, and where your economy is at, it is not that inflation has not come down from 9%. It's that my prices for what I'm buying have not come down. And because inflation is persistent across the board and I still have inflation, the consumer is tapped out. So McDonald's is really important. Taco Bell is really important. KFC, all these are important because these are folks that have traded down from a more expensive restaurant like an Applebee's or something. And I put this also in my LinkedIn post. Is I've been listening to Bloomberg Surveillance. They're great on the yield side. They're great on the interest rate debate. But if you listen to them, they said the other day that on the Jersey Shore, a Miller Lite cost $14 at some bar, which is just insane. And that in California, because they've had the minimum wage increases, a salad at Chipotle is $36. This is really untenable for places that are supposed to be this fast casual, right? This is where, and I order Chipotle, I get a burrito bowl and I get a bag of chips. It's $20 on DoorDash when you include everything in. That's not cheap, folks. $20 for a meal is not cheap. So unless you have doubled your income since 2019, which most people haven't, that is materially eroding people's ability to buy things. And so for a lot of folks who haven't doubled their income, where the jobs growth is in leisure and hospitality, those folks are living paycheck to paycheck. And so this inflation is really impacting them. And what I hear from my family and what I hear from folks across this country, if you get into an Uber in Pittsburgh, get into an Uber in Denver, what you hear from folks who are working class people is that their utility bills are up, their gasoline bills are up, and the grocery store prices are killing them. And that's why it's so frustrating to listen to the stock market and the people talking about interest rates and the fact that we need to lower interest rates because we need to lower the interest that people are paying on their credit card debt. Absolutely not. If you lower interest rates right now, you will never see inflation cool on housing, which comes back into rentals, and you will never see anything there. We probably have a disconnect there that's going to go on for a while, but you're not going to see prices lower on anything else either. So Jerome Powell, what he said he said a few times, or he clarified, and he tries to keep this clear. And this is where I don't think these doves in the market or these people saying, hey, we need to lower interest rates, they really hear and understand when he says we have to achieve our target of 2% for inflation because it will pay dividends in the future. And the reason this is so important is because the past 30 years, we have not seen inflation. You can parse out the charts. You can look at this where we've seen, even in 2008, where we saw a period of high inflation, it came back down. And so since then, you've seen high oil prices, but you don't have inflation. Now we have this elevated inflation and we have higher oil prices, and we sort of have elevated inflation overall. And this economy and the last 30 years is just not used to this. And I think really importantly to realize is the stock market's not used to this either. So you are going to have to adjust to the whole market, and the whole global economy is going to have to adjust. And this is important in the context of oil prices and the global economy, because what you're seeing in Europe and European Central Bank is that they're willing to lower rates. But they also don't have the same economy as we do, right? They don't have the same growth that we've had. And when they're lowering rates, it's because they actually need it. Europe, Germany has had 2 consecutive quarters of lower economic growth. So they're actually technically in recession. And so you see material declines within these countries, and they're going to lower rates. Now, whether or not they will see a resurgence in inflation is a question, but they're seeing a decline. What they're seeing on a decline in inflation is partly because they don't have as robust of a economy, but also they don't have the same fiscal spending that we do. And so we are in a big pickle in the U.S. where we now see in the data from KFC to Pizza Hut to Taco Bell to Starbucks to Estee Lauder, talking about the U.S. decline in the U.S. As well as the decline in China. You're seeing the consumer tapped out in the U.S. across the board when it comes to the Nike is another one. And you see this, and almost all these guys say when they say a decline in the U.S., they're also saying a decline in China. The China piece is important because it's also U.S. brands that are declining as well. So when you see this material decline in the consumer in the U.S. against the backdrop of these persistent of this sort of sticky inflation, and against the backdrop of these you're going to have elevated interest rates, it tells you that there's not enough steam left there's not enough steam out there, right? That we're kind of stalling. And so that, in the context of the global economy stalling, I do think gets us to this piece of, $79 oil, and the headline on CNBC saying, US crude oil falls to $79 a barrel, 7-week low as stockpiles surge and lackluster demand. The fact that you see these headlines say lackluster demand is pretty important. So I think, and you see this if you look at EIA, and I'm pulling up some data points on EIA, is that they have a nice in there today in energy. They have a nice decline, or they show a chart that shows not that this is good or nice, but a decline in diesel demand. Now, part of this they attribute to the substitution with biofuels, especially in California, but also diesel demand makes sense that you have some softness. If you look at the monthly diesel demand, if you look at weekly, you see material softness in U.S. diesel demand. This makes sense in the context of all the stuff I'm talking about from these stores and from the retail side and from the consumer, is that you're going to have a decline. I know I'm not buying as much on Amazon. I would bet that most people are not buying as much on Amazon. I would bet that most people just aren't buying as much stuff because discretionary income is not there, and because there's a lot of anxiety of where things are going to go. I also think it's important to think about, when you're deciding what to do if you have cash, right? So if you get the economy to a more stable place without inflation, and you get the consumer where they're comfortable, and you also have interest rates that are not zero, you incentivize the consumer to actually save. And that in saving, that incentive to save is helpful to the economy. One, it provides a cushion, and two, it pulls it out of the system that's creating all this inflation. So it's a balance that we're just not seeing right now. And we have an unbalanced economy, which that's why I'm critical of the Fed to the degree that they just keep coming out there and saying, we're doing okay. But they were late to the gate to curb inflation early on and get rates and start raising interest rates. They have not addressed the fact that we have so much fiscal spending, and everyone thinks they're late to the party on lowering interest rates. I do not think that. I don't think they're late to the party on lowering interest rates. If it's not going to be higher, it's not going to be 5.25% interest rates that are going to throw this economy into a tailspin. If the economy goes into a tailspin, it is everything else, which is the consumer being tapped out. And again, the answer to the consumer is not to give the person who can't afford McDonald's cheaper interest rates on the credit card so they can rack up debt and pay for that McDonald's. The answer is you have to have a reset, right? And we have a bigger problem. We have a bigger problem with the economy. And I am concerned with this because the other headline, so Google lays off on CNBC, a headline, Google lays off hundreds of core employees. So we see this from Tesla to Google to other major tech companies. We saw big tech layoffs last year. You don't hear about this enough, I think, in terms of what is this actually doing. And, we would hear about this more if there were massive layoffs and people wanted to move. We do have this thing where people can't move because they're stuck at their 3% mortgages, and that means no one's selling. I've said this before and I'll say it again, and I think we have to beat the dead horse with this. If you see bigger layoffs, that forces people to move, either because they can't pay their mortgage and they need to go move in with their parents, or they need to move to another job or to go look for work or to take a lower income job or something. And that means that incentivizes people to sell. And that's that's a chain reaction. And now, that being said, I just think it's really important that if Google is laying off on the core and they're moving some positions to India and Mexico, they're looking for the lower prices. Again, this is inflation. Jerome Powell did talk about and address wage inflation, and he said this is not a direct component of the Fed, nor is it a mandate of the Federal Reserve to address wage inflation. However, it's a pretty big deal. It's a pretty big deal because he discussed it in the context of if wage inflation is a component of inflation, and so if wage inflation if it stays elevated, basically just gets reset in the system, and that results in price increases across the board. So that results into the business that's experiencing the wage increases where they have to pay the employees more, they have to raise prices, and then you see this throughout, cascading throughout the system. So, and something he also said clearly was, hey, when people get a wage increase, but that if that only gets eroded, if that's burned by the sunlight, or it was somebody on Bloomberg, I think, that said it. If you get a wage increase only to go out into the sunlight and have that wage increase evaporated because your prices at Starbucks and McDonald's are so high, it doesn't matter if you got that wage increase. And that's the problem that we have when people talk about raising the minimum wage. You're just raising the bar of the lower end. It doesn't change anything because everything raises, prices raised with it. And this is basic economics that I think that people in the stock market and people in the economy just haven't had to talk about or deal with it, nor have a lot of business leaders dealt with it, because we haven't had it over the course of the past 30 years. We really have not seen this in my lifetime. We haven't seen this really materially since the 1970s. So it's not, and again, I'm not saying this is stagflation like the 1970s, but there's a lot of similarities to the 1970s, and the playbook, no one's had people have had it easy. People trading stocks, people, financial advisors, a lot of folks, honestly, I know we've had volatility, we've had 2020, we've had pain, and we've had 2008, but most people, when they tell you financial results, they'll talk about post 2008, right? And so since 2008, things have been actually relatively easy. And I think now with sticky inflation, 5.25% interest rates, again, which I do not think are that high, and elevated oil prices and all this geopolitical risk and tension, this is not your typical economy that people are just going to be able to ride through. Okay, so Tesla, I want to know. There's a couple other. I want to cover some newsworthy items on some articles as well, just before we wrap this podcast up. So you got pullback in Google, you got pullback in Tesla, you got pullback across the board on the EV space. Really, you do have, and then you have, but you keep hearing all this hype on the tech side, right? Just on the chip side. But you are seeing pullback in certain chip areas that aren't outperforming because everybody expect them to go nuts. So I think this is a bit of a tale of two worlds on the, are you NVIDIA or are you not? And everything's heavy in the Mag 7, which is now basically the Mag 2. So, but the point is that, Tesla, they're pulling back. The fact that they're pulling back at all on sales, on everything, Wall Street Journal notes that, quote, Tesla is pulling back from EV charging and people are freaking out. And the reason this is material is because the fact that Tesla's pulling back at all means they're pulling back on charging, which means that this whole game on Tesla, building out the charging stations and building out this electric vehicle infrastructure, is now being thrown into doubt. There's being cold water thrown on this. I've been trying to talk about this with clients and with listeners for a while, is that I think there is I know there is a global reset happening around the conversation around the energy transition. It's people are I heard a phrase today, energy addition. We've heard that. It's not an energy addition. It's not an energy transition. This is basically, we're just going back to energy. And the things that are happening in places like where AI is saying we need energy and we need power demand, they're going to buy it. They're going to get it from coal. They're going to get it from natural gas, no matter what. They need it to make their business work. But when it comes to the EV side, that rise in utility prices, which I've talked about, is really serious. And so I think that the cost structure, and Tesla is obviously an anomaly because it's a very recognizable brand. People love it because of the brand. They love the cars, but it's not something that translates all the way into lower end consumer. And now you can't even look at this if you were to say, you have a lower end consumer that's just completely tapped, they're not worried about the environment right now. They're not worried about CO2 emissions. They're not buying an EV because it's great. The only reason they're going to buy it is if their utility bills are low and the EV price is low. And that's not what Tesla's offering, or anyone is really offering, except for very, very cheap Chinese auto manufacturers right now. And I think the China point is important to mention, and simply because there was a recent chart from the EIA, which is actually pretty good, and it's just a very simple chart showing the record volumes of crude oil imports into China. It's a very nice, in addition to that nice diesel chart, it's a really nice chart that just shows that, hey, we're almost at 13 million barrels per day for 2023 Chinese crude oil imports. That's important to think about in the context of the fact that Estee Lauder, McDonald's, Starbucks, Nike, all these companies essentially said that all their sales were really down in China. Apple. Now, part of this story in China is that they are pushing more domestic brands, right? The Huawei phone, everything over Apple. There is a shift in, a very nationalistic sentiment going on in purchasing, but really it is about the consumer being really tapped out and the consumer not spending. They have deflation there. The folks are very nervous. Consumer sentiment is poor, and so they're not spending. That's interesting and should be very, very interesting to folks in the context of the fact that companies like Dow Chemical are doing well in China. The fact that you see the energy side doing well. The fact that you still see a 2023 was the crappy economy, but they're importing nearly 13 million barrels a day. That's 100% stockpiling, folks. But the fact that when you hear these other companies on the industrial side doing well, that tells you something very, very unique. One, it tells you that they are definitely supporting the Russian economy, but there may be some war footing going on within China. And I know that's very uncomfortable for people to hear, but it's just a reality. You can't have a very, very weak consumer, but this robust growth everywhere else. Something isn't matching, right? And you see them doubling down like crazy on electric vehicles, on wind turbines, on batteries, and dumping them and exporting them like crazy. That massive material growth that we've seen just over the course of the past couple of years to help them offset in their economy. But I think it's really important what we see on the Russian side, because we did see Secretary Blinken just go over to China. He met with folks in China, and he also met with Xi Jinping. There was a lot of back and forth of China just saying we need to be a better partner, blah blah blah. But Blinken was saying, hey, I mean, we essentially told them, if you don't rein this stuff in terms of helping Russia, we're going to sanction you. Now, it's serious in the context that we know they've been doing this for a long time. We should be telling them you can't be buying Iranian crude because that's sanctioned as well. But I think you're starting to see this in the data from a company perspective. If companies on the industrial side and the energy side are doing well in China, but the consumer is doing that poorly, then there is something going on, something very, very real going on. And we know that they've been sending auto exports. We know that they've been sending tech exports and ammunition. And they say nothing's directly, and even the U.S. government says it's not directly helping, but it is. It is directly helping them. And there's no way that the Russians could get through this without Iran and without Chinese support. So it is important to think about that. One, China is directly supporting Russia, and I think there's something supporting their overall economy is this war footing. Whether it's them directly on a war footing or whether it's their support of Russia, it's still a war footing, and it's meaningful. Now, I've been doing a lot of listening and studying to Nazi Germany economy and the rise and fall of the Third Reich, so I kind of have this in my head. But it's very interesting to think about in terms of what is supporting the Chinese economy and why there's such a big divergence between the consumer and the industrial sector. And this is it's not rocket science, folks. It's the military stuff. Okay, that's a nice little segue to a quick geopolitical spiel, which is you continue to see Houthi attacks in the Red Sea. So even despite seeing oil prices dip to $79 a barrel, when you see all the stuff in the news and the media and the market, it covers up everything else, and so you don't hear what's actually going on. So when Blinken was over in China, you heard a lot about that. When Janet Yellen was in China, you heard a lot about the dumping of the EVs and green tech and everything happening around the world. Now, all you're hearing about is Fed rate volatility, U.S. inflation. And so you weren't hearing as much about China. You're not hearing as much about Russia. The bill that we actually passed, the spending bill to go for money to go to Russia, for money to go to Taiwan, for money to go to Israel. Lots of question marks on the Israel-Gaza ceasefire front. But that was passed in addition to a TikTok ban, which is everything staying really, really quiet. That TikTok ban is a forced sale of TikTok, which the Chinese say they're not going to do that. So that's a big question mark. So the point here is that the China tensions are not going away. But I also think that the reason you shouldn't get overly anxious of crude oil prices dropping off a cliff, even though I think there's some material signs, as I noted with the diesel demand in the U.S., with some worrying signs in the U.S. We have to be cautious about that. We certainly need to be cautious about it globally. But that being said, there is so much geopolitical tension in the world that you have a geopolitical risk premium in crude oil prices that needs to be there. I've talked about it in previous podcasts where you have a lot of spare capacity. If Saudi Arabia needed to ramp up production, Russia's producing a lot. We are back to over 13 million barrels a day in February. So there's a lot of production on the market, a slower economy. But the geopolitical risk there's a an article on CNBC that's really the headline is Russia shows off NATO military hardware captured in Ukraine, Moscow to beef up weapons, frontline forces. So we do know, if you're following the military stuff, I've mentioned Institute for Study of War, which is a great place to look at this stuff. But if you're following this, Russia has been gearing up for an increased offensive. They've been pummeling. They've been pummeling Ukrainian infrastructure to prevent them from actually rebuilding, on the energy front, from preventing them from actually building out missile defense systems. Anything that they can help them on the defense side, which requires energy infrastructure and electricity, anything that can make stuff, ammunition, everything, that's what they're hitting. So the fact that they're gearing this up. We know this offensive has been going. They're pummeling this, and showing this off I think it's a morale booster. But they showed this tank with with flags on it, with a British flag on it, which I think is very interesting. But the point is that this is an ongoing war. This is a geopolitical hotspot. This is very, very real, and it's something that often gets lost in the news when we're talking about Jerome Powell speaking for the day. So something really important to keep thinking about. And then Wall Street Journal has a great article, another map. I showed these maps a lot, but it's the Houthis continual attacks within the Red Sea, but also not just the Red Sea now, extending into the Indian Ocean. So when we talk about the Red Sea and we talk about everything that was going through the Red Sea, the only countries that are able to ship stuff through the Red Sea now are essentially Chinese companies. So Chinese companies are basically, every time a Chinese vessel goes through, they tell and send out that they are a Chinese flag vessel. They're completely Chinese owned, so that they don't get hit. And so anyone who is supporting the war in Israel, is supporting Israel in any way, that's who the Houthis are attacking. So we're basically skewing this toward, this is again another benefit to China. They're being able to ship through the Red Sea. That's a significantly shorter route and going through the Red Sea than it is going around Africa and around the Cape of Good Hope. And it's important to realize, so when you go through the Red Sea, you go through the Suez Canal. So it's the Gulf of Aden. And I encourage you to just Google this and look this up, but look up the Red Sea, make sure you can see this on a map, and think about, if I can either go through the Red Sea, or I have to enter the Suez Canal, or I can go all around Africa and the Cape of Good Hope. That's a lot more time. And so that is real inflationary pressure that we see in support for crude oil prices, because the ships that have to go around obviously need more fuel, and they're more time on the water, and that's costly. So that increases the cost of that. So increase the cost of fuel. It'll put pressure on oil prices, on diesel prices, on bunker fuel, but it will also put pressure on overall inflation for goods. And that's at a time when, as we've talked about, the consumer's already tapped out. So that this stuff is very, very real. The Houthis have not stopped attacks. We've seen them actually go further out into the Indian Ocean, sort of around the Horn of Africa. I do think it's really important. No one's talking about the fact that, no one's really escalating the conversation about the fact that the Chinese and Russians can move their stuff through, that the Chinese are advertising the Chinese vessels so that they can move their ships through, and that the fact that they own the port of Djibouti, and they're right there. They're right in this Gulf. They're right in this choke point where they have a military port now in Africa. And, if they really care, which they don't, obviously the Chinese don't care about helping the West, but they would be helping. So they're not. And I think these continued Houthi attacks, they've essentially said they're going to continue to attack as long as this is going on. So again, the point I'm making is that this is really serious. This is not going away. This is part of the geopolitical tensions. I think the other geopolitical tension, which I mentioned previously, it's continuing to escalate in the Philippines. That shoal, that vessel, that World War II vessel that's run aground, that the Philippines still has. Watch that space closely. This is still going on. This is something I believe that Blinken and some people over there address. But this is stuff that, just you can keep kicking it down the road, but this is all stuff that's going to materialize and be talked about within the U.S. elections, and is just extremely messy and very volatile, and something that is definitely elevating and supporting oil prices right now. Okay, so I'm going to close by talking a little bit about U.S. energy, U.S. oil and gas production, just because the data came out yesterday, and I think it's important to update it. I am going to be doing more work on U.S. shale. I just talked with a good friend, Aaron Hunter with ConocoPhillips. He's been on the podcast multiple times. He's going to be coming back on the podcast, and we're going to be talking about the efficiency gains on the drilling side, which, I just can't underscore enough the fact that we are seeing this new low plateaued rig count, and that we're still seeing production elevated. So I was really, really anxious to see this production data out of the U.S. Because for February data, because we came off so much in January, we nearly closed 2023 for a total year at just under 13 million barrels per day. Again, that's more than any country in the entire world, especially for the year. We've only seen Russia and Saudi Arabia for a moment, increase production to 12 million barrels a day because the market didn't need it. We are consistently producing. We're now back above 13 million barrels a day, 13.154 million barrels per day in February. That's a winter month. And what's so impressive is New Mexico. Sam Shiverick and I talk about this in the podcast that I recorded yesterday with him, which will drop in a week or so. It's such an amazing story in New Mexico because they have a tough political environment, tough regulatory environment, but holy crap, Lee and Eddy County are just marching forward. The rock is so phenomenal. The pressure is high. These wells perform. Yes, they get a lot of natural gas, too much natural gas right now with negative Waha prices. But right now, with high oil prices, you have these high liquefied natural gas prices. And you see this in the data. Basically, I think it's really important for people to look at production data, folks, because no matter what oil prices are in the U.S., production in oil and gas, but particularly oil, gas goes up, but production oil goes up too. And you really see this in the state of New Mexico. We are at just shy of 2 million barrels a day at 1.982 million barrels per day for the state of New Mexico. That's two counties, Lee and Eddy County. And I think it's really critical, folks, to just think about this in context of the world environment. And it's also important to think about in terms of these efficiency gains, what they're doing, and the fact that we may stay now at this new low plateaued rig count because we are drilling these longer laterals and because we are getting more from the rock. And then we can, in more podcasts, we'll be talking about the evolution of shale oil and gas, which is, next with the stuff that Buckhorn production is doing with that Sam Shiver talks about is buying existing assets, buying production, buying stripper well production from unconventionals and breathing new life into it and thinking about the longevity of U.S. shale, which I think we barely skimmed off the top of that. So I think that's really, really important. So third generation oil and gas, I'm just really proud of that. I think it's awesome that we're back to 13 million barrels a day. It's incredible. And also awesome, EIA has a great chart that the U.S. in 2023, no shocker, also dropped CO2 emissions by 3%. So just put this in context, folks. I always tell people in Colorado that we are 0.3% of global CO2 emissions, but U.S. energy-related CO2 emissions in the U.S. dropped by 3%. That is largely because half of our grid is natural gas, folks. So if you want to lower CO2 emissions, which I do not think is the main thing we should be targeting in the world right now, but if that's your goal, then you allow as much natural gas into the grid as humanly possible. So it is a really good chart. We're going to continue to see. You're going to continue to see these declines, but and that's the global reset, I think, and rethink. That's the reality that's going on within companies, within banks, and everyone realizing is that we will be using natural gas forever. And lastly, I'm going to close on something political because this is the year of elections. I just have to, the Biden administration, every time they do something, it seems like they're just catering and pandering to 24-year-olds and this younger voter, which it makes it seem like those are the only people voting. So I just don't think, I don't know if this is a smart move by the Democrats, but anyways, the Biden administration is looking to loosen marijuana rules. And this just seems very similar to lowering, trying to get rid of student loan debt, and also trying to everything that they've been doing on the climate front and this potential of listing, climate as an existential threat. So it's simple. It's not that big of a deal, but it does seem right in line with the student loan stuff. And I don't actually know if this is a big enough base. I also think it's important that apparently the U.S. House Democrats are accusing quote big oil of climate change, quote denial and doublespeak. This is really important because this is from the Financial Times, and this is talking about companies like Exxon and others that are being accused of denial and doublespeak. And I've been talking about this a lot. I think it's a great point to close on, but I really think these companies, especially if you're a publicly traded oil and gas company, this is the time you really have to be articulating to the street what exactly you're doing. But I think also because we have this global reset going on around energy and the fact that everybody was so inundated with this noise on the energy transition and going crazy on this, and now we have inflation and rising power demand and all these needs, it's very important for the energy industry to be very clear about what they're actually doing. And so I think you can get rid of the doublespeak by leaning less into the transition and the stuff that doesn't actually make sense and make money, and just leaning into your business, and being very, very clear and thoughtful about that. So I think that's incredibly important. I can't wait for the podcast with Can't wait for the podcast with Sam Shiverick with Buckhorn to drop. Really, really great podcast and a great example, folks, for if you are on the fence, if you want to dabble with PetroNerds, come reach out, talk to me. I loved having great guests on the podcast. I do have a lineup of folks that are sponsoring the podcast. The listener base is fantastic. The reviews of the podcast have been really, really good. I care about putting out rich content. I care about people, the reviews I get are really good, and people are really appreciative of the information, not just the oil and gas industry, but people outside of the industry as well. So thank you guys so much for listening. I really appreciate it. And lastly, I will point out there was an article that I was quoted in with inside sources, and that was on the EPA ruling on, again, comes back to the power generation side and natural gas, but this was on the EPA ruling that is the Biden administration basically bringing home their plans on climate, saying that they are, again, part of the whole political thing and the young people and the voting is that they are going to make natural gas-fired power plants and coal-fired power plants all within the next few years all have to capture all their CO2 emissions. My quote was pretty bold in saying this is basically decimating the U.S. economy. It really is. If you are going to force power plants to capture all these emissions, the cost is extremely high, and something that makes countries so competitive and why this is so important to think in the context of China is that you're basically relegating all our production of all our goods, including ammunition, including equipment and things that we need in the world, and especially rebuilding up militaries and having ammunition. You're relegating that to China because they're making everything with coal-fired power generation. And the fact that we have lowered our CO2 emissions and we have half of our grid is natural gas power generation, this is a reset, folks. This is time to wake up and realize that policies like this absolutely do not work and are killing the consumer, which I've spent the first chunk of this whole podcast talking to you about, a consumer that's already decimated. And I really think policymakers need to start being the ones that they need to start going to the grocery store and filling up their tank and realizing how hard it is and what real inflation is like. So with that, folks, thank you guys so much for listening. Talk to you soon. Bye.